Hello and welcome to the channel. I am a chartered accountant and here we focus on advanced tax strategies, wealth structuring, and smart investing, tailored specifically for high-income professionals and entrepreneurs in the US, UK, and Europe. If you're earning six figures or more, here's a reality check. The tax system wasn't built for you. In fact, if you're not structured properly, it actively works against you. Today we're breaking down how top earners in the US, UK, and Europe legally reduce their tax burden without loopholes, without breaking the law, by using frameworks most people don't even know exist. This video isn't about tax tricks, it's about systems. And once you understand how income is taxed across regions and how the wealthy structure theirs, you'll never see your payslip the same way again. Let's begin with a hard truth. Earning more doesn't mean keeping more. In the UK, the moment your income crosses £125,140, your personal allowance is clawed back entirely. This creates an effective marginal tax rate. US example, someone earning $250,000 through W-2 employment pays federal, state, Social Security, and Medicare taxes with few deductions. But another person earning $250,000 through an S-corp can pay themselves a reasonable salary and take the rest as dividends, avoiding nearly 15% in self-employment tax on that excess. They've just saved 20,000 plus per year legally. In the UK, if you earn via pay, you're fully exposed to national insurance and income tax, but if you operate through a limited company, pay yourself a small salary, and withdraw dividends, your overall burden drops sharply, even more if you contribute into your pension or use your ISA allowances. In Europe, it gets more interesting. Countries like Portugal offer the non-habitual residency (NHR) scheme, where most foreign income is tax-free for 10 years. Italy offers a €100,000 flat tax on global income for new residents. Belgium charges no capital gains tax on shares held by individuals. The wealthy don't necessarily work harder, they structure smarter. Now let's get into region-specific strategies. In the United States, start with your entity. If you're a freelancer, consultant, or business owner and you're still a sole proprietor, you're losing money. Use an S corporation, split your income between salary and profit distributions. Pay yourself just enough to satisfy the IRS and take the rest at lower tax rates. Next, leverage real estate. Through cost segregation and bonus depreciation, you can write off massive portions of property value, sheltering passive rental income. And don't overlook the solo 401k or backdoor Roth IRA. These let you invest six figures annually in tax-deferred or even tax-free accounts. Advanced play, the Augusta rule. Rent your primary residence to your business for up to 14 days per year and deduct the full amount from the business. The income, not taxable personally. Used correctly, this creates a legal, invisible income stream. In the UK, the most powerful tool is incorporation. Use a limited company, take a basic salary, and pull the rest as dividends. Combine that with employer pension contributions, and which are corporation tax deductible, and you've now created pre-tax wealth building. Don't stop there. Use your £20,000 ISA allowance for tax-free investing. Use your £60,000 annual pension cap to lower your corporation tax and grow retirement funds tax-free. Then there's the family investment company, a strategy often used by the wealthy to house investments, reduce inheritance tax, and retain control over assets passed to children. More advanced EIS and VCT investments. These government-backed schemes offer up to 30% income tax relief, tax-free capital growth, and loss relief if the company fails. This isn't aggressive planning, it's endorsed by policy to encourage investment into the economy. Across Europe, in Portugal, the NHR scheme offers a decade of near zero taxation for expats. Retirees, remote workers, and even digital nomads are leveraging this for enormous tax savings. In Italy, for €100,000 per year, new residents can cap their total global tax exposure, a favorite of HNWIs relocating from Latin America or Asia. In Belgium, there's no capital gains tax on individual share disposals, meaning your equity portfolio can grow untouched. In Switzerland, the lump sum tax agreement lets wealthy foreigners negotiate a fixed amount with the canton, often based on lifestyle spending, not global income. And if you're building or selling companies, Ireland's holding company regime allows profits to be rolled over with deferred taxation, a key reason so many tech founders incorporate there. Now you might be thinking, these sound complex. Do they actually work? Let's walk through a real case. Meet David and Alex. Both live in London, both earn £160,000 a year. David is an employee, taxed via pay. His total tax bill, around £63,000. Alex operates through a LTD company. He pays himself a £100 salary, takes £50,000 in dividends, contributes £40,000 to his pension, and uses his full ISA allowance. His tax bill, less than £30,000. Over a decade, that's over £300,000 in savings, compounded into millions if invested right. Same income, different structure, completely legal. Another example, a dual citizen in Germany and the US was earning $220,000 and paying over $95,000 in combined taxes. After restructuring through a US LLC taxed as a partnership, claiming German tax credits, and shifting capital to a Luxembourg holding company, she reduced her total tax to under 30% without renouncing either nationality. This is what the ultra-wealthy understand. So what can you do now? Start with a tax efficiency map. List your income types: employment, dividends, capital gains, property, consulting, business. For each, ask, is this income earned or passive? Can it be shifted to a more efficient wrapper? Am I taking full advantage of retirement vehicles, regional tax shelters, or entity structures? Then look at your geography. Are you living in a high-tax country without exploring cross-border options? Could residency changes or company relocation create long-term arbitrage? Most importantly, stop viewing your accountant as just a filer. You need a strategist, not a form processor. You don't need millions to start. You just need to treat your tax plan with the same care you treat your income plan. Because wealth isn't just about how much you earn, it's about how much you keep. Subscribe if you're serious about building strategic wealth, not just income, and comment below, US, UK, or Europe, which region should we break down next? The strategies are out there. This channel brings them to light so you can build after-tax wealth like the top 1% do every day. I'll see you in the next one.